According to supply managers in the 9 Mid-America states, how is the economy performing?
The overall index improved significantly to 57.4, well above growth neutral from 50.3 in June. So things are looking much better. At least we're still not back in terms of jobs from pre-COVID-19 levels, but we're moving in the right direction. This was as good a survey as I think we could have hoped for. We need several more months of above growth neutral readings to really feel good about the regional economy. And here I bring up a chart showing over the last 18 months. There in blue, the Mid-America region. You see there the rebound from April's reading, April, May, and then June, and July. And you see 57.4 for July. And the U.S. number comes out later on this morning. I expect it to be up as well. So all across the U.S. and in the Mid-America region and most all the states that we survey, the numbers are looking better. We're seeing new orders improving, production improving. So we're moving in the right direction. Still got a long way to go though.
What were the hiring trends?
Hiring still is a lagging indicator right now. The July hiring index was still below growth neutral at 48.5, but that's well up from June's 38.9. We're down about from pre-COVID-19 levels. The region is down about 900,000 jobs. Most of the states and the overall region down about 6.5% from February numbers, and that's of course pre-COVID level numbers. 55% of the manufacturers indicated that they had reduced employment, and so we've got a long way to go yet. Again, about 900,000 jobs we've got to add to get back to pre-COVID levels, but we're moving in the right direction.
What impact is inflation having?
Wholesale inflation index was up quite significantly at 65.2 in July, up from June's 59.7. I still expect no inflationary pressures for 2020, but I do expect 2021 we'll see some upward inflationary pressures as the economy, we see the impacts of the increasing federal support payments and also the Federal Reserve's expansionary program, which is going to push prices up. But I, again, don't expect that until the second half of 2021. And if you look at the COVID-19 impacts, 80% of the manufacturers reported negative impact. 55% reported hiring reductions, and that compares to 49% in April. So we're moving again in the right direction, even in terms of hiring, still not back to where we need to be. 70% of the manufacturers reported shipping problems. The supply managers reported difficulties in terms of getting shipments out and shipments in. That's up from 51% in April, so there's some real issues there in terms of shipping. 48% reported worker absences, down from 61% in April, so that's at least a better number than what we've been seeing.
What does the Mid-America economy need?
Well, we need some trade. We need really the trade numbers, an upturn in exports, and the export reading for July was 47.8, and that's up from June's 26.4. Still, the movement's good, still not above growth neutral. We need to see exports increase. Now, we did see imports rise above growth neutral at 53.9, and that's up from June's 32.0. So things are moving in the right direction, but really trade, we need to see some trade. Obviously, we need to see a vaccine or have a vaccine. The COVID-19, as we talked today, is still in charge, and that will be the major factor that will determine where the regional economy is going. In my judgment, we need to see more reductions in tariffs. We need to see more immigration, see those trade flows increase, and also the flow of workers into the U.S. Believe it or not, we're still seeing a lot of companies reporting difficulty in finding and hiring workers. Now, why is that? Well, it's because in many cases, workers are now being paid more to remain unemployed. That's with the $600 per week unemployment insurance support that's coming from the federal government. Now that runs out that has run out. Now we'll have to wait and see what the Congress approves. The Republicans want $200 per week. That's about 70% of the replacement wages. The Democrats want it to remain at $600 per week. Now that's above what you get for you get less for working than you do for not working. I think that's a mistake. So we need to see the approval of the Republicans' plan, not the Democrat plans.
What are some areas of risk that we need to monitor?
We need to keep an eye on the 10-year Treasury. That yield has now moved below 0.6%, indicating investors are still scared out there, global investors, and they're buying bonds, pushing up the price and the yields down. If the yields begin to rise toward 1%, that would be a good signal. Need to keep an eye on that. We need to look at the jobs report on August the 7th, and that's for July. That would be the employment and unemployment numbers. Need to look at weekly unemployment, first-time claims for unemployment insurance, and look at the continuing claims. Right now, there's a real huge, significant disconnect. The Department of Labor's numbers for first-time claims and continuing claims are significantly higher than what we're seeing from the BLS. The BLS, unfortunately, there's a margin of error there that's too large. I think you have to go with the numbers coming from the Department of Labor. That's the continuing claims for unemployment insurance. That's a better measure than the jobs report, but still keep an eye on the jobs report. Also look at the Creighton's Rural Main Street Survey results. That'll be a very important number coming out, telling us how the rural economy is doing in the 9 states. And also gold prices. Since the COVID-19, prices are up by $397 per ounce. That's up by 25.5%. And so what we're seeing, again, these are factors to watch, but a lot of what's going to happen, of course, and most of what's going to happen in terms of the Mid-American region is going to be determined by the virus, whether we get a vaccine or not, and where we have continuing closures of some of the state economies and some of the areas in the state economies. That's what we really need to watch. I'm against those lockdowns. They've demonstrated that they really don't slow the virus to any significant degree, and they increase unemployment and reduce employment. So not good. We're going to have to go with opening the market. So that's it for this month. Until we meet again the first business day of next month, may your economic cup runneth over.